Let me ask you something really honest. Have you ever looked at your credit card bill? Seen that little number at the bottom? The one that says minimum payment due? And felt this quiet wave of relief? Like, okay, I can handle that. That's manageable. I'll just pay that for now and deal with the rest later. Maybe you've done it once. Maybe you've done it for 6 months straight. Maybe you're doing it right now, and you open this video with a little guilt in the back of your chest. And here's the thing, I'm not here to judge you for that. Not even a little. But I do want to show you something that the credit card companies figured out a long time ago. Something that most people never fully see. Because the math is deliberately designed to stay invisible. Because the moment you truly understand what happens when you pay just the minimum, everything changes. So let's talk about it. Calmly, clearly. Like two people who actually want to figure this out together. Here's where most financial content gets this completely wrong. They come at you with shame. Stop buying lattes. You're terrible with money. You lack discipline. And look, I understand why that framing exists. It's dramatic. It gets clicks. But it also misses the entire point. Because the truth is, the minimum payment isn't a trap that catches foolish people. It's a trap that was specifically engineered to catch normal, reasonable, psychologically predictable human beings. There is a difference, a significant one. Think about how the minimum payment is actually presented to you. It's not buried in fine print. It's right there, front and center on every single bill. Bold, clear. Sometimes it even comes with a little checkmark option, as if the credit card company is helpfully reminding you that this is an acceptable choice. And in the short term, it genuinely is acceptable. Your account stays current. You avoid a late fee. Your credit score doesn't take a hit. If you're in a month where money is tight because rent went up, or your car needed work, or you had a medical bill you weren't expecting, paying the minimum might actually be the most rational decision available to you in that moment. The credit card companies know that. That's actually part of the design. See, the minimum payment feels like a life raft. And when you're financially stressed, you grab the life raft. You're not thinking about where the life raft is slowly drifting to. You're just relieved you're not drowning right now. That's not weakness. That's how human psychology actually works under stress. Our brains are wired to prioritize immediate relief over long-term consequences, especially when we feel overwhelmed. Researchers have a name for it: present bias. We consistently overvalue what helps us right now and undervalue what happens 6 months, a year, 5 years from now. Credit card companies didn't accidentally stumble onto this. They built their business model around it. So before we go any deeper, I want you to release the self-blame for a second. Not because what's happening isn't a problem. It is. But because shame doesn't actually help you see the math clearly. And the math is what we need to look at. Okay, let's get into the actual mechanics of this. And I promise I'm going to keep it as simple and visual as possible. Imagine you've got a credit card with a balance of $3,000. That's not some outrageous number. That's actually slightly below the average credit card balance for someone in their late 20s or early 30s. Maybe it built up over a year. A little groceries here, a flight there. Some months where the paycheck just didn't stretch far enough. Your card has an interest rate of 20%. Again, not a horror story number. The average credit card APR in the United States right now is somewhere between 20 and 24%, depending on the card. Your minimum payment, let's say, is about $60 a month. Which sounds reasonable. $60, that's 2 dinners out. That's a streaming service and some groceries. Manageable. So you pay $60 every month, faithfully. No late fees, no missed payments. You're doing what the bill says to do. Here's what's actually happening. That 20% annual interest rate doesn't sit quietly in a corner. It divides itself by 12 and visits your account every single month. So every month, roughly 1.67% of whatever you still owe gets added to your balance as interest. On a $3,000 balance, that's about $50 in interest. In the very first month, you paid $60. $50 of that went straight to interest. Only $10 went toward actually reducing what you owe. Your $3,000 balance is now $2,990. $10. You paid $60 and chipped away $10. Now carry that forward. The next month you owe $2,990. The interest charge is slightly lower, maybe $49.83. Your minimum payment has also dropped a tiny bit, because minimum payments are usually calculated as a percentage of your balance. So maybe you owe $59 this month. The math shifts in tiny fractions, but the pattern stays the same. The cruel irony is that as your balance slowly shrinks, your minimum payment also slowly shrinks. Which sounds like good news. But it isn't. It means you're always paying just barely enough to keep the interest monster fed, without ever really slaying it. If you sit down and run this out, and I did, because I genuinely wanted to see it clearly, paying only the minimum on a $3,000 balance at 20% interest will take you somewhere around 11 to 12 years to pay off. 12 years for $3,000. And in that time, you'll have paid close to $4,500 in interest alone. Let that sit for a second. You borrowed $3,000. You'll pay back more than $7,500 in total. The interest cost more than the original purchase. And again, this isn't some extreme scenario. This is completely average numbers playing out for someone who is doing exactly what their credit card statement tells them to do. Now here's where it gets even more interesting from a pure business perspective. Because when you understand why banks love this, you start to see the system from the outside instead of the inside. Credit card companies are not in the business of helping you spend money conveniently. That's the feature. The business is interest. The business is time. The longer your balance stays alive, the more money they make. It really is that simple. And the minimum payment is essentially the exact threshold that keeps the balance alive indefinitely. It's calibrated, not by accident, not by regulatory requirement, to be just large enough that your account stays current, but small enough that real progress on the principal feels almost impossible. There's actually a term for this in finance. Some people call it the debt treadmill. You're moving, you're paying, you're doing something, but you're not really going anywhere. And the view outside the window stays exactly the same. Now, I want to go a layer deeper here because the psychology of this is almost more important than the math. One of the things credit card companies do extremely well is normalize the revolving balance. Every ad, every offer, every credit increase letter, all of it is framed around the idea that carrying a balance is just a normal, everyday part of financial life. Buy now, pay later. Enjoy the flexibility. Manage your cash flow. And over time, this language actually reshapes how you think about what you owe. The balance stops feeling like debt. It starts feeling like just a number that lives on a card. Almost like a utility bill that you manage month to month. But there's a fundamental difference between a utility bill and revolving credit card debt. Your electricity bill doesn't grow if you carry it. Your credit card balance does. Every single month that the principal stays unpaid, the interest compounds. Meaning it adds to the base amount on which next month's interest is calculated. That's the compounding engine. And it works exactly the same way that investment compounding works, except in reverse. And against you. Here's a way to visualize it. You've probably heard that if you invest $1,000 and get a 10% return, you don't just earn $100 a year forever. In year 2, you earn 10% on $1,100. In year 3, on $1,210. The snowball rolls downhill and picks up size. That's compounding working for you. Now flip it. You owe $3,000 at 20% interest. If you're not paying enough to cover the interest, your principal grows. The interest calculates against a larger number. And that snowball now rolls uphill against you while you're trying to push it down. The reason banks love minimum payers isn't evil genius level cynicism. It's just math. A customer who pays their full balance every month is actually somewhat less profitable because the bank makes money on interchange fees from merchants, but very little from the actual cardholder. A customer who carries a balance and pays the minimum is, from a pure revenue standpoint, almost the ideal customer. They never default. They never stop paying. They just keep going. For years. And there's one more layer to this that I think is really worth sitting with. The minimum payment is often framed as a kindness. The bank is giving you flexibility. They're not demanding the full balance. They're meeting you where you are. And emotionally, that framing works. We feel grateful for the flexibility. We feel like the system is accommodating us. But consider what's actually happening. The bank isn't being flexible out of generosity. They're being flexible because your ongoing interest payments are their ongoing income. The longer you need flexibility, the better it is for them. The kindness of the minimum payment is a business strategy, not a customer courtesy. That realization, for a lot of people, is genuinely the first moment where something shifts. Not anger, just clarity. You start to see the relationship for what it actually is. So here's the moment I want to offer you. The minimum payment isn't your enemy, and the credit card isn't the enemy. The enemy, if we want to call it that, is invisibility. It's the part where the math happens quietly, in the background, in language that most people never fully decode. Because once you see it or really see it, the way we just walked through it, you can't unsee it. And that's actually powerful, not frightening. Here's the shift I want you to consider. When you look at your credit card balance, stop thinking of it as a number. Start thinking of it as a cost per month. That $3,000 balance at 20% APR, it costs you roughly $50 every single month just to exist. Whether you use the card or not, whether life is going well or falling apart. $50 every month just for carrying that balance. What else could that $50 be doing? What would it feel like if instead of going to the bank, that money was going anywhere else? Into a small emergency fund, into a savings account, into something that moved your life forward instead of keeping it in place. That framing, debt as a monthly cost, not just a number, tends to change how people feel about aggressively paying it down. It stops being about discipline and starts being about buying back your own breathing room. And here's the thing about interest rates that I think most people never emotionally connect to. Paying off 20% interest debt is the guaranteed return equivalent of making a 20% investment. You will not find a safer, more reliable 20% return anywhere on earth. Every dollar you throw above the minimum payment on a 20% card is a dollar earning you 20% risk-free. That's not a motivational platitude. That's just the arithmetic. There's also something deeper happening when you start to gain traction on debt. And I think this is underappreciated in financial conversations. When you carry a balance that feels permanent, it creates a kind of low-grade financial anxiety that lives in the background of everything. You don't always notice it consciously, but it's there in the way you avoid opening your banking app. It's there in the tension when you use the card again. It's there in the way you've started thinking about money as inherently stressful, rather than as a tool you're learning to use better. Reducing the balance, even slowly, even imperfectly, starts to lift that background weight. Not all at once, but you begin to feel less like the debt is controlling you and more like you are moving through it. That psychological shift matters. It makes the next good decision easier. And the one after that. All right, let's talk about what this actually looks like in real life, because I don't want this to be a video that leaves you understanding the problem without any sense of how to move. And I want to be honest with you up front. There's no hack here. There's no one weird trick. What there is a handful of straightforward moves that work better than doing nothing. And that you can actually start with the money you already have. The first one is so simple it almost sounds too obvious, but it's the most powerful thing you can do in the short term. Pay more than the minimum. Not dramatically more. Not some heroic sacrifice, just more. Take that $3,000 balance we talked about. If instead of paying $60 a month you paid $100 a month, your payoff timeline drops from 12 years to somewhere around 4. You save thousands of dollars in interest. You didn't triple your payments. You didn't give anything up dramatically. You paid $40 extra a month and the outcome changed completely. That's not a hustle culture pitch. That's just compound interest working the other direction. The second move is what people call the avalanche method. If you have more than one card, and a lot of people do, list your debts from highest interest rate to lowest. Put any extra money you have toward the highest rate debt first, while paying minimums on everything else. When that one is gone, roll that payment into the next one. Mathematically, this costs you the least in interest over time. Some people prefer the opposite approach, the snowball method, where you pay off the smallest balance first regardless of interest rate. Mathematically, the avalanche wins. But psychologically, the snowball gives you faster wins. And for some people, those early wins are the momentum that keeps them going. Neither approach is wrong. The right one is the one you'll actually do. The third move is something a lot of people overlook, and it feels almost too passive to be real. Call your credit card company and ask for a lower interest rate. Seriously. Just call. If you've been a customer for a while, if you've been paying on time, there's a non-trivial chance they'll lower your rate by a few points. It's not guaranteed, but it costs you 5 minutes. Even 2 percentage points less in APR changes the math in your favor. The fourth thing, and this one is really about protection, not about paying off debt, is the emergency fund. I know that sounds counterintuitive when you have debt. Why save when you're paying 20% interest? But here's the quiet truth. The reason most people add to their credit card balance is not frivolous spending. It's emergencies, a car repair, a medical bill, a month where something just went sideways. Without any buffer, every emergency gets charged, and every charge at 20% APR becomes part of the treadmill. Even a small emergency fund, $500, $1,000, whatever you can scrape together over a few months, acts as a firewall. It means the next emergency doesn't have to go on the card. And that keeps your progress from being undone every time life happens. The fifth thing is almost more philosophical than practical, but I think it matters a lot. Stop using the credit card for spending categories where you know the balance won't get fully paid. I'm not saying never use credit cards. There are real benefits to cards when used cleanly. But if you're carrying a balance and you're still swiping on groceries or takeout or subscriptions, the balance never gets the chance to actually shrink. You're filling a bucket with a hole in the bottom. Pick one area, even just one, where you switch to cash or debit for a few months. Watch what happens to the balance. It's not about suffering. It's about stopping the leak long enough to actually make progress. None of these are extreme. None of them require you to upend your life or eat nothing but rice. They're just slightly different decisions made consistently over time, and that consistency is the whole game. I want to end with something that I think is more important than any specific tactic. You didn't end up here because you made bad decisions. You ended up here because you're a person living in an economic environment that is specifically designed to make revolving debt feel normal, comfortable, and manageable. The system isn't broken. It's working exactly as intended. But now you can see how it works, and there's something genuinely freeing about that. Not because the debt disappears the moment you understand it. It doesn't. But because you can stop feeling confused or ashamed, or like somehow you just don't understand money the way other people do. You do understand it. Now even more so. The minimum payment is not a finish line. It's a floor. The least the bank will accept before they start charging you fees. Your job isn't to clear the floor. Your job is to figure out how far above the floor you can reach in your specific life, with your specific income right now. And right now might be $10 above the minimum. That's okay. That's still moving. That's still the math shifting in your favor instead of theirs. Progress in personal finance is almost never dramatic and linear. It's usually quiet and uneven and sometimes backslides. That's not failure. That's just reality. The person who figures this out and makes consistent, imperfect progress over 5 years ends up in a genuinely different place than the person who kept paying the minimum and wondering why nothing changed. Not because they were smarter or more disciplined or more deserving. Just because they saw the machine clearly and started making slightly different choices. That's all this ever is. You're already doing the right thing by wanting to understand it. The understanding is the first step. The next step is whatever small thing you can do this week. $1 extra above the minimum. 1 5-minute call to your bank. 1 look at your statements with fresh eyes. Progress beats perfection. Every single time. If this helped you see something differently, share it with someone who might need to hear it. And if you want to go deeper on any of this, whether it's the psychology of spending, how compound interest actually works in your favor when you invest, or just how to start getting organized with money, there's a lot more here on this channel. Take your time. You're already moving in the right direction.